This is Wallet Brief, where we break down what actually moved the US economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Over the past few months, interest rate expectations in the US have shifted multiple times. Earlier in the year, markets were anticipating relatively quick rate cuts as inflation cooled. But as economic data remained resilient, especially in jobs and services, those expectations have been gradually pushed back. This created a pattern where the Federal Reserve moved from tightening aggressively, to pausing, and now to holding rates steady while waiting for clearer signals. This week, the latest developments reinforced that cautious stance. New data and policy signals suggest that rate cuts are not imminent. Inflation remains somewhat elevated, and the labor market continues to hold steady, reducing the urgency for immediate easing. Financial markets reacted by adjusting expectations again, with projected rate cuts shifting further into the future. Bond yields showed modest movement, reflecting continued uncertainty about the timing of any policy change. So what's the real trend right now? Interest rates are staying higher for longer. The direction may still point toward eventual cuts, but the timeline is becoming less certain. This week strengthens that delayed easing trend. The Federal Reserve appears focused on avoiding premature rate cuts that could reignite inflation, even if that means keeping borrowing costs elevated for a longer period. So how does this hit your money? For borrowers, this means continued pressure. Mortgage rates remain high, making home financing expensive. Credit cards and personal loans are also staying costly, which can impact monthly payments. For savers, the environment remains relatively favorable. Savings accounts and short-term deposits continue offering better returns compared to previous years. This creates a split effect: borrowing remains expensive, while saving remains attractive. For many households, managing that balance becomes key. Looking ahead to next week, markets will be closely watching any new inflation indicators and statements from Federal Reserve officials. Even small changes in tone could shift expectations quickly around when rate cuts might actually begin. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with